if it cost us an extra 20% to sell a car in Germany than it does for the Germany to sell a car here, how is that fair?
Hmm.
Right? Who does that hurt? The American auto worker, you
Yeah.
know? And so, yep, I'm hoping we come out of this all right.
Well, how do you have a solid game plan for retirement when the market has been as volatile and turbulent as it has been? We'll talk about it today with Northwestern Ohio's resource for a common sense approach to planning for your financial investment and retirement future. He is president and founder of McIntire Retirement Services. Chris McIntire here with us on your game plan for retirement. Chris, we have certainly seen our fair share, more than our fair share, of market shakeup and turbulence, and unfortunately, nobody loves them, market losses and downturns as of late. And I know that by the end of our conversation, the market's going to be in a different place than it is now. But how do we plan effectively? How do we create and craft and execute on a plan when the market can be as volatile as it's been recently?
Yeah, buddy, it's certainly a gut check out there for millions of Americans. I mean, we've seen trillions of dollars of, let's call them paper gains, obviously, because there are also paper losses too. Um, or, trillions of dollars wiped away. And, it's hard not to get emotional in times like these. But, if you look at it in, I kind of been playing this back and messaging out with our current clientele and whatnot is that, in 2018, they raised interest rates four times by 1%. Okay. And we had more negative asset classes that year than any time in history: oil, lumber, stocks, bonds, okay, than any time in history. 2019, then they cut interest rates. Okay. And again, this is in President Trump's first term. Might as well put that out there. Okay. Um, Market recovered nicely. We hit COVID. Okay. The V-shaped drop, we'll call it V-shape, V down, V up. Recovery quite quick because the government came in and injected, let's call it someplace between 6 and 8 trillion dollars.
Trillions.
Yep.
T's on the beginning of those numbers. Yeah, trillions
Yeah.
of dollars.
Yep. So again, with COVID, sharp down and then a V-shaped recovery because of all that government dollars put into place. And, the market ended up being okay just because it was, propped up by government spending. Okay. Then we go to 2022. All that government spending led to inflation and let's call it inflated stock gains as well, right? Because they were government inflated. All that money came out. They raised interest rates 11 times, right? The stock market down, depending on what index you want to use, let's just say in the range of between 20 to 25%. I know the Nasdaq was down more than the S&P 500. Bonds, worst year in history, okay, for bonds, modern history. Let's say that because it'll get through our compliance office faster. And then we hit 2024, 2 years later, markets rocking and rolling, doing pretty well, slowing down. The economy was certainly slowing down here a little bit as we were coming off of all this government fed stimulus, if you will, which helped fuel the stock market into more of, all right, we're bringing it back to the real economy, consumer spending, not government spending. Typically, our economy is 70% consumer spending, 30% government spending. That's, a 30,000 foot breakdown of it. Okay. And then President Trump comes in and, starts these, with the tariffs and all that he had been only talking about for about 40 years. And, I think in the middle of all of this, I'll try to defray and from trying to be one-sided versus the other, because you can make arguments both ways depending on what your backgrounds are here.
Sure.
Is it going to be better in the long term? We'll have to wait and see. We're right in the middle of the storm, and it always seems the worst. Okay. So, 2018, 2020, 2022, and now 2025. So, these weird kind of events that we see here, I shouldn't call them weird, but these market driven one way or another by the government, by geopolitical, by regular political pieces here, happen quite often. And that's why you have to build your portfolio, around your overall risk tolerance, because you don't want to sell into cash and all of a sudden say, okay, I'm out. And then all of a sudden the market bounces 7%, right? Well, that's 7% that you're never going to get back either. So, you have to, it doesn't mean you can't make some adjustments. And I'm sure you'll probably feed us into that here as we go through our conversation today, buddy.
Yeah. Uh, Chris, I actually like the term weird because as you were mentioning those things, I was thinking to myself, and on top of all of those items, from time to time, the economy sees regular business cycles. There's times of growth and expansion, there's times of contraction, there's times of boom and bust. And I feel like those air quotes here, weird events, that series of those four separate things over the last 8 years that you mentioned, like none of those to me constituted just a natural business cycle cool down. We've kind of been foot on the gas accelerator for the better part of 15 years in the markets. And at some point in time, whether it be hidden beneath the surface and these weird events kind of overrode it, but isn't there an element of a natural business cycle where you've kind of got to burn the brush so the forest can grow in addition to those events that you mentioned?
Yeah, good perspective there, Peter. And I also use the analogy of when the British at Bletchley Park cracked the Enigma machine that the Nazis were using. They still had to lose battles to win the war overall, because if they would have spilled their candy, the Germans would have known they cracked the Enigma code. So they still had to, it's some tough sacrifices. I don't know if that's an apples and oranges comparison, but me being a history guy, that's what ran through my head. And as we're looking forward here now, I mean, the United States is the economic driver around the globe and have been here for quite some time. We've been really outpacing, especially the European markets. And some of that was starting to reverse here, and nobody just prior to the tariffs here. So nobody really knows where that's going to go until we get on the other side of this. And I think I'm going to come at it from the argument that, if it cost us an extra 20% to sell a car in Germany than it does for the Germany to sell a car here, how is that fair?
Mm-hmm.
Right? Who does that hurt? The American auto worker, you
Yeah.
know? And so, yep, I'm hoping we come out of this all right. We're drinking a lot of it with a fire hose right now instead of bits and pieces. But, I mean, tell me who has the negotiating power right now? Japan or the United States, China or the United States. And, I think as we talk a little bit about China here, we look back through history, China's been around for thousands of years, many empires and dynasties and whatnot that they've created. They are a formidable foe, and I even had quoted a Rudyard Kipling poem into an email to clients several months ago. Might have even been a year ago, that says, and the epitaph drear, a fool lies here who tried to hustle the East. China wants to take Taiwan, right? That's pretty public knowledge in the year 2027, are we in something a little more than a trade war with them? Is that where this ends up going? And, trying to cripple them economically would certainly be a strategy and an overall, um, defensive measure, if you want to call it that. I think that's the geopolitical risk right now. I see, what does the U.S. do if they attack Taiwan?
So many different factors play into our individual financial well-being, Chris. It's overwhelming. It's scary. I mean, we got to worry about trade wars and tariffs and what's going on in China. We've got to worry about Russia and Ukraine and wars there, the Middle East and wars there. And then again, like COVID disrupted things, a surprise out of left field at the time. We've dealt with that now for 5 years and the lingering effects, but so many things. And yet we need to stay sane and have foresight through it all to make wise financial decisions. And I think that's where preparation is critical. Not just a benefit, but absolutely necessary is that we have to have a plan in order to make our way through these difficult times and these sometimes foreseen and sometimes unforeseen events that are going to get in our way between here and there, and keep a long-term perspective on our goals with sound financials in place. And I know that that is a large part of what you help people with there at McIntire Retirement Services is formulating, documenting, writing, executing, monitoring, and continuing to implement the planning. The plan that goes along is what allows us to keep a level head and good psychology about the challenges that we face with the market and with all of these kind of events. And ladies and gentlemen, you need to have a plan. Again, not just a benefit, but an absolute necessity. And if you would like to get your game plan for retirement, a personalized plan with diversified strategies and a long-term vision, pick up the phone and give Chris McIntire and McIntire Retirement Services a call. They can be reached. They've got offices across Northwestern Ohio. Convenient for you to come in for a visit. They teach educational courses at local colleges throughout the area. They are available for phone calls. They are available for virtual meetings, but get that conversation started and get a plan. And by the way, investment in the S&P 500 does not constitute a plan. Having a 401k does not constitute a plan. Those are important pieces, but you've got to bring it together into a plan that helps you to envision and keep in focus that long-term goal. And that's what they put together, your game plan for retirement. So give them a call, no cost, no obligation to get your game plan for retirement put together. 419-332-0532, 419-332-0532, 419-332-0532. Chris, am I understating the importance of having a plan and being prepared ahead of time at all, do you feel?
No, no, not at all, buddy. When, we have clients that have been with us for, say, 20 years, we have some that have been with us for, say, 20 weeks, or 2 months. So, your conversations are certainly different there. And, some strategies and things that we're doing right now for the current clientele is, many of them have safe money strategies. So, we're going to switch income from coming from investments that have taken a hit. And again, this hit has been in such a short amount of time. It's, you got to be careful not to be knee-jerk reactive in this, And what was it? John Templeton, his famous words were, hey, be very careful this time is, in saying that, well, this time it's different,
Uh-huh.
and
Uh-huh.
and you can run that analogy any way that you want.
And
But
oftentimes it is slightly, but it is eerily reminiscent of times in the past, right? It doesn't
yep,
repeat, it often rhymes. And
yes,
don't jump out and be knee jerk, because the bull will come again, right? The rise in the market does come around, and if you get out at the wrong time, you're changing your trajectory, um, possibly not for long-term benefit.
yeah, and and I think empirically speaking here around the globe, that no one wants economies to crash and whatnot, right? Because I mean, you get civil unrest and things like that. Here in the United States, we have the midterm election, so this administration's got to get everything done that they want to get done before those midterms, because they may lose one of the bodies of the House, and you could probably make an argument that that if people had to vote today, those undecideds are probably decidedly the other direction anyhow. But Peter, we're also $36 trillion in debt. Our debt is becoming a national security risk because now the risk premium that you're putting in place when a bond interest is implied, right? Everybody says, well, U.S. government bonds are the safest, until nobody wants to buy them,
Mhm.
because of the credit card, and think of it this way, Peter. I was telling a story, and it might be a good way to do it. Is say, yeah, imagine you ran a company and your company went in debt every year. You lost money every single year, but you could fill out another credit card application and start paying the interest on the previous ones, and you didn't want to lay off any employees because look, everybody's, they're nice people, they got families, they have to pay mortgages, and you think you have a duty to keep them employed at any cost. So you continue to borrow more and more money versus cutting your expenses. Okay. And you just keep borrowing more and more dollars. And again, look, you're a big, safe company. Anybody will give you a check, right?
Mhm.
Anybody give you credit. Interest rates were low, and then something happened. You know,
Mhm.
interest rates went up. Okay. The money was getting harder and harder to get, but you still didn't want to lay anybody off, right? Because they're good people, they have mortgages to pay, I mean, that's the difference between a government and a corporation. A corporation has to sustain itself, and just kind of storytelling, along those lines. Imagine if the US government was a business.
Yeah. Now, Chris, I'm listening to your story. I've seen it firsthand. I had a acquaintance and knew somebody who owned a restaurant, and she really strongly believed in paying people more than what they were being offered or receiving at other restaurants. And she took a stand on that and then eventually went out of business, and had me really reflect on, as a business owner, your job is to be able to continue to be able to provide people the security of a job, not just a flash in a pan, but to be there and to grow and to offer more and more stability for those workers and everybody involved, and the services that you provide, to be able to continue to offer those. And yeah, that national debt, circling back to this, just being able to move the credit card balance from 1 0 interest rate to the next, and continue to play that credit card bill shell game. Eventually they stop offering the credit. And that is where, not only do you go through that catastrophe or that unexpected event, but you also are then burdened by the debt on top of that. And Chris, I know that at a certain point in time, like, the government has acted like this is not an issue, but to your point, to your statement, eventually this is a national security issue that we all are going to have to face if the government continues to refuse to do so.
Correct. And I would think that Japan, who owns more US debt than any other country, when they come into Washington, I understand they're probably here now or going to be there soon to make some negotiations, are going to want some fiscal responsibility to continue to hold that debt because, they obviously don't want to dump it. But imagine if they did dump it, what interest rates would do. They would skyrocket. So that just adds into uncertainty and whatnot. Whereas if the U.S. was like the German government, for example, runs a balanced budget and surpluses and things like that, a little more fiscally responsible, how much solid that would make the United States economically be. And we do have some tough decisions, and you can like or dislike the current administration by all means, and we can all pick pieces apart, but at least somebody's here dealing with it. They're not kicking the can down the road anymore and say they're not going to touch Social Security or Medicare. At some point, they're going to have to. Those are unsustainable as well.
So many factors go into this,
Yeah.
and things that we need to be concerned about. And Chris, changing those concerns over the last 7 to 8 years, we've heard so much about the meteoric rise of just a few behemoth select companies, the Magnificent Seven, they've been dubbed. And now this year, those are the same companies that have led the way on the way down and lost the most value. And those companies are so large that they move the entire markets, and many mutual funds are highly concentrated in those same behemoth companies. Does this eerily remind you of the tech bubble and the overweighting in 1999, and then the 2000 through 2002 crash? The fact that so many people have so much over concentration in just kind of one particular area of the economy, or such a few select companies?
Yeah, I believe those seven companies are responsible for 30% of the performance of the S&P 500 because they had gotten so large. And, so of 500 companies, seven of them are 30% of the performance. That's a very high concentration, obviously. So that's why you've seen the NASDAQ, the S&P 500, and then the Dow that only has 30 companies in it that, are industrial sized in nature, kind of a different makeup. So those indices are performing differently. So, I mean, there's always the shift in, there are low volatility ETFs that are out there, but obviously bonds are performing better than, as that defensive measure right now to cushion some of that blow. And, I think most people, if you said, hey, given your risk profile here in the moderate range, would you be comfortable losing 10% over the course of a year if we had a significant correction? And most people in the moderate range are going to say, yeah, I'm okay losing 10% because I know what the upside can be. Okay.
Mhm.
But when it happens in a week, right, that changes the perspective and nobody quite knows what the future is going to be. So we're kind of right in the middle of this. And, there's a lot of money sitting on the sideline. So when people have the confidence, because at some point stocks can only fall so far like they did in 2020, where there's going to be a great buying opportunity. So if you do have money on the sidelines, here's a great opportunity. If your IRA is down significantly in value, do you do a Roth conversion now and then let it recover income tax free? Usually it's early in the year to kind of have some of those Roth conversions, but we've had a couple of them already with clients. We have clients that either have cash in money market, CDs, their fixed annuities, index annuities, and we're taking some withdrawals from them and adding them into their investment portfolios. Again, with the buying at low prices might be a great opportunity to get some money, back into the market and replace some of what you lost. And if you can buy at a pretty depressed price right now, you get your potential for capital gains obviously is going to be greater. So those are some strategies. Roth conversions, adding some dollars into here, it depends on what you're looking at. If you got $50,000, maybe you say, okay, I'll put 10 in this week, 10 in a month later, kind of that thing. Doesn't have to be all one fell swoop, but just throwing some strategies out there.
No, and thank you for that, turning the corner as we close in on the end of the program. There's a little bit more time to discuss those, but I absolutely wanted to. Like, that's the point here, Chris, is that, like, what do we do now, right? And I want to go back and emphasize again that having a plan allows you to be better prepared to identify opportunities at any point in time, but especially when there is a bit of chaos going on. If you've got a plan, you can identify those opportunities much more accurately, ladies and gentlemen. And it's not a bad time to put a plan together right now, because looking at the market, yes, we've fallen a little bit, but we are about where we were in the market only 6 or 8 months ago. It's not like we've lost decades of ground here. We're still, relatively speaking, hovering close to all-time highs within, the last couple years. So, like, let's take a step back from the concern and the worry and the panic, and let's formulate the plan. If you don't have one, let's review and double check the plan. Even if you do, if you've got concerns right now about the volatility, it's probably a strong indication that you need that game plan for retirement. Chris McIntire and his team there at McIntire Retirement Services would be happy to talk with you, help you back up, review, assess, and formulate the plan, evaluate the current plan, the investments, the accounts that you have, the risk exposure that you are taking, the comfort level that you have with it, and make sure that it's all in an alignment with your personal goals, your long-term objectives, diversified strategies in place. Give them a call, 419-332-0532, 419-332-0532. But Chris, you mentioned several opportunities there, and I wrote them down as you were going. I just want to recap. You mentioned bonds. Like, bonds are finally sort of holding steady the more traditional way. They have not seen the volatility. Rebalancing if things are off kilter, making sure that we are in proper alignment, fixed interest rates, payout rates, contributions, conversions. All of these are things that, with a plan in place, you've helped your clients to identify during periods of good and during periods of chaos to make sure that they are executing to make sure the money's working toward those long-term goals.
Yeah, absolutely, Peter. And, we talked to a lot of people who are taking their, dividends and interest. And, you have to they say, hey, my account has fallen down in value, but we're looking at the cash flow. The dividends and the interest are still paying down. We're not selling stocks to create your income. We're using the dividends that are still coming out. And, it's a big switch. Most people are used to putting money in, not taking money out. So, we invest differently when we're taking money out than typically when we're putting money in. And hey, you and I aren't insulated from any of this either. You and I are both pretty heavy risk takers as well. So we've probably taken a heck of a lot more hit to certain parts of our portfolios than our retired clients, where we're taking a much more cautious approach.
It's all relative, right, Chris? You gotta look at where you are, and if you are moderate or moderately conservative, you should not be expecting to beat the returns of the S&P, nor should you expect to lose as much during downturns. And likewise, if you are younger and more aggressive, maybe it's time to put the foot on the gas, be a little bit more aggressive, find some extra cash to invest during periods like this. But it all boils down and comes back to having that plan in place. And that's what allows you to see clearly through the cloudy chaos and identify those opportunities. So to get your game plan for retirement put together, it is the written plan, ladies and gentlemen, that documents your situation, your goals to the future, and the steps to get there from a perspective of income, investments, taxes, healthcare, legacy. Pick up the phone, give McIntire Retirement Services a call, 419-332-0532, 419-332-0532, 419-332-0532, or you can go online, McIntyreRetirementServices.com, McIntyreRetirementServices.com. And Chris, we do always appreciate the perspective and helping us keep a level head. It's kind of been easy as the market goes up. It's not, until the tide goes out that we see who's swimming without a bathing suit, as Warren Buffett says. Yep. But if we feel like we are at risk, good indication, it's time to give you a call and get a plan put together.
Yep, sounds good, Peter. And thanks everybody for listening. Be safe out there. God bless America.
Tune into Chris McIntire's full radio program and visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.